thank you so much for having me here, especially to Juan and to Tim for the very gracious invitation. A great difficulty in putting together conferences, since I have been in that chair as well, is that you like people to talk about a certain topic and then give it a certain structure to the day, but then of course people want to talk about some slightly different things. And so relative to the invitation, which I got and was very happy to accept a few months ago, as I was thinking about why inflation went up in the last 2 years, I've changed my focus in the last month to try and be more forward-looking and think about, will it stay up or not? So I'm going to deviate a little bit. Maybe my paper should really have come in the third session, and it's really not Juan's or Tim's fault, but it's really my fault. Because I really want to focus on whether inflation is going to stay high in the next 2 years. And that's what I'm going to spend my 25 minutes on. I think the points that I will make, though, apply to why it went up in the last year and a half. So I won't be completely out of line, but I will abuse my right away and unashamedly abuse the invitation to do so. As a little bit of context, and I used here just some numbers from the euro area, although one could do some for the UK. It is important just to understand that sometimes when these discussions come in, I'm struck by how, even if qualitatively good points are made, quantitatively, in terms of the actual numbers of how big things are, quickly that really forces you to focus in some way. Inflation is remarkably high right now. For the euro area, which had started here, the euro in 1999, this is a finance market people you will hear love talking about sigma shocks. This is a 7 sigma shock. Okay? It is a remarkable increase in inflation relative to what had been the norm beforehand. Much, much above NT4. For the Bank of England or for the UK, it's more. It's a 2.5 to 3 sigma shock. Sigma being standard deviation, just because inflation tends to be more volatile. But still, it is a truly remarkable high level of inflation. And when you ask about the context in which this happened in a context in which the unemployment rate has fallen like a rock. In the euro area at 6.5%, it is the lowest ever. Unemployment has never been as low in the euro area. And at the same time, what has been happening to monetary policy? Well, a way to measure the stance of monetary policy is to look at not so much the interest rate set right now by the ECB, but the expected path over the next year or two. So let's use to measure that the 1-year interest rate, a 1-year interest rate on an OIS swap, and subtract from it an expected inflation over that similar horizon, so that we can get a measure of the real interest rate, the real stance of monetary policy. Well, this is from the Bundesbank survey of German households, but the ECB survey of US households shows the same. It's running roughly at around 8%. That means that 1.5 minus around 7.5, we're talking about a minus 6% real interest rate. More, as inflation is shooting up, you simply subtract that from this, you have that in the last 12 months we had the greatest, by this measure, which is a pretty accurate measure, at least one that was used for a long time, the greatest monetary loosening that we've had in a while. 300 basis points. 3.5% was how much the real interest rate fell. Even as inflation is shooting up. And you say, oh, but it's because there's some massive depression we need to fight. But unemployment is the lowest ever. For the UK, the picture is very similar qualitatively. Inflation running at above already, almost 12%. Unemployment at historical low levels, extremely low levels. And again, an interest rate that's risen more. In the UK, the 1-year rate is a couple of percentage points above. And inflation expectations, those are similar. But again, a monetary loosening from this measure of interest rate. So that's a quite remarkable context in terms of how does this quite add up? Why are we loosening policy even as inflation is exploding? With that context, as I said though, I want to look forward and ask, will we, I think it's very hard to describe this as not a mistake. Maybe not a purposeful mistake, maybe an honest mistake, but something just doesn't seem to quite add up at this very basic quantitative level. We could look at monetary aggregates instead, but I'm a very interest rate driven person, so I will look at that. But I think we can tell actually a story, a very consistent story here using monetary aggregates. What I want to do though in these 20 minutes that I have is ask, what could prevent though our central banks from reaching their 2% inflation target in 2 or 3 years? So in 2025, end of 2024. Okay? Why do I ask that question? Because I start by asking, can the central bank achieve 2% inflation in 2025? And the answer is, and as I think the introduction, I remember it was Tim or Juan who said, there's going to be disagreement. I'm a very staunch, if you want, monetarist. I think if monetary policy can deliver inflation, it wants to, it will deliver inflation. And I mean this in the sense of, sure, just hike policy rates enough. You could always deliver 2%. I'm not saying you should, but can you deliver 2% inflation? Yes. If you're ready to hike interest rates to 5, 10, 15, 20, you can bring inflation down. And I see nothing in the data that tells me that that's not the case, that is impossible to do it. You can do it. Okay. Should it do so? Well, I think the euro area is a good example. That's why I like to use the euro, because the Maastricht Treaty is as clear as it gets. In the short run, the ECB can trade off of the goals, but if you talk about 2025 and talk about medium term, it has to deliver 2%. It has no other mandate to do something else. The Bank of England, you could argue, no, well, not quite, depends on the remit that's given year to year. That's why I'm going to focus a lot more on ECB, just because it's so clear here. And then, if nothing else, if you reject the arguments of the stock, you'll say, well, for the Bank of England, we don't have to achieve 2%, we don't want to. I don't think that's interpretation of the mandate, but certainly it's fair. So then, if you can, and you should, the question of will you do so is, well, maybe you won't. And I'm going to use a word that has been used in economics for many decades, and I'm going to try to expand that in this talk to talk about if you don't, it's because you were dominated. And by dominated, I mean there's some other factor, some other agent that told you that even though you could and you should, you didn't. I want to think through, over the next 2 years, what could those factors, what could those agents be? What kind of dominance should there be? Note that if I was looking just over the next 6 months or year, I'd be talking in terms of trade-offs. Maybe I don't want to. I should not do so. It's because I don't want to bring inflation down to 2% in 6 months, because that will destroy the economy. When I look at the medium to long-term horizon, though, there should be no trade-offs, because the treaties are clear, because the goals are clear, and because delivering inflation is your goal. Then, if you start telling me about trade-offs 3-4 years from now, you have become dominated. And you'll see already how some of the factors are indeed things that we have thought about as trade-offs in the short run, and the dominance comes when you start extending those to dominating your actions in the medium run, in the 3-year horizon. So, number one, every time I'm going to start with the evolution of some theory, tell you a little bit about how the central banking fit into that, meaning what does monetary policy fit into that, and then define domination and discuss whether it is likely to happen. A little bit of theory. At a very elementary level, a nominal interest rate, think about a policy rate set on average over these next 3 years, is going to be approximately equal to the private real rate of return in the economy plus an expected inflation. Okay, this is known as the Fisher equations. What does the central bank do over a 3-year horizon is to think, boy, there's going to be some real rate of return out there. As long as I add here expected over these 2 years 2%, that's roughly what should be my nominal interest rate. And this is sometimes called the neutral interest rate in parlance of literature. Okay? As long as you can track, difficulty with that is you know this is should be 2%, but this is going to be moving around. So the difficulty is to track what it is. It must be observed. It's not observed. It must be estimated. Okay? When do you get inflation then over a 3-year period? If you underestimate what the neutral rate is. If you keep on setting, essentially, policy rates too low, too long. Okay? When is the central bank then dominated by misjudgment? When it clings to outdated theories or measurements of the economy, it finds excuses always for why inflation keeps on rising, even though, and yet it does not choose to raise rates appropriately. Because so it says, no, the neutral rate is lower than what someone else is thinking, or what actually is the case, and as a result, inflation accelerates. The dominating agent here, in some ways, is the staff of the central bank that keeps on saying, no, interest rates of 3% are just what we need, and inflation is good. It's just about to come down just around the corner. And then inflation doesn't, and they say, well, maybe it's not 3%, but 3.5%, without realizing that actually the right number should have been 4.5%, 5%, 6%, or 7%. So I'm going to call it misjudgment for the staff of policymakers dominating them. Today, looking over the next 2.5, 3 years. I think some simple calculations for the first ECB and the UK show how this dominance could appear. Starting with ECB, the real rate of return over the next 3 years, I think, is around 1%. There's been some arguments. Some people may say maybe 0, 0.5, but people may say 2. You add that a 2% inflation target, and you end up with a long-run neutral rate of at least 3%. Yet the ECB is talking of an inflation rate, of raising interest rates to 2. Right now, they're announced to stop at 2, 2.5 at most. Look instead from a Bank of England perspective. Rather, again, we think about the real rate being around 1%. Imagine you say the expected inflation is not like 8, as I showed you 2 slides ago. You say, well, that's overstating because of the energy effects. It's something like 5. Well, 5 plus 1 is 6. Yet the Bank of England is saying, we're hoping to raise rates to 4.5 at most. Now, they may be right. But these benchmarks tell you that misjudgment dominance is not out of the table. I'm not saying that we should raise them to 6 or to 4. I am very humble about my ability to estimate the natural rate. But I do see too much determination of central banks on all of it one-sided, on it being just much too low. And the second form of this dominance, I think, and part of it, comes from a conceptual point. To measure the neutral rate over the next few years is hard. One thing that anchors your thoughts is what's going to be the neutral rate over the next 10 years, so 5 2-year periods. That sometimes gets called R star for the long-run component of the neutral rate. Now, measure that R star, therefore, gives you that anchor. Central banks throughout have been focusing a lot on this black line to measure R star. Actually, this is R star plus inflation, so plus 2%, but anyway. So subtract 2 from there if you want. What is that? That is the average return on a government bond, which has been falling like a rock for at least 20 years. However, during that same period, you measure returns in the economy. And remember, private real rate of return is what you show up there. And what you see is not much of a fall at all. The main fact of the last 20 years is that there's been an enormously rising wedge between the returns offered by government bonds and the returns offered by the private economy, once you look at a broad set of equities, corporate bonds, and others. There's been a lot of research trying to explain this, all of which goes under the heading of there's some specialists of government bonds, convenience yield as sometimes it's called. And many theories of why that is, because government bonds offer you store of value, safety, liquidity, collateral, shield against financial regulations, and a series of others. But either way, this 1% comes from focusing on that black line and adding a little bit. Yet R star is somewhere between the green and the black line with some waves. All of the estimates are very much geared towards the bottom end of what is possible, and especially, and very noticeably if you follow the UK events of the last month, insofar as we start questioning how safe, how liquid, how valuable government bonds are, and that specialist erodes, this gap is going to have to close down. Maybe we'll close down with the green line going down and R star is indeed 0.1, or maybe it's going to close with the black line going up. And in doing so, actually we're going to need a real rate, a rate that's higher and higher because R star will be rising. Second form of dominance, expectations. Let me describe expectations. It's a very rich literature on expectations. I've won some prizes talking about expectations. I will not go into the details of those, even though I could for hours. But let me describe 3 types of agents, if you want, 3 types of forces dominating expectations. The first one is what I'm going to call the capital of inattention. If you've been a central bank that for 20 years has kept inflation at 2%, people, wage setters, firms, are going to trust you to deliver 2% no matter what, are going to devote their attention to instead their lives, how to run their businesses, how to pay attention to their investments and other things. That's great, because no matter what happens, they're going to say, what do you expect inflation to be? 2%. That's why I call it a capital that the central bank has earned. They're going to say 2%, no matter, even if inflation is 10, they believe it's 2. Another set of agents, sometimes even almost called backward looking, I'm going to talk about them as the, if you want, the incredulous ones, say, the last 12 months inflation has been 8%. I expect inflation is going to be 8%. I don't care what the central bank says. They're the ones who don't believe the central bank at all. I just care what I see. Yes, I know you give speech. I know you have a mandate over the next 3 years. Again, my horizon is always over the next 3 years. I think over the next 3 years, it's just going to be whatever it was. And then there's a third type of agents, which are the ones that, and this is no matter what you do. The third type of agents are the ones that, depending on what the central bank chooses, that's going to affect their expectations, and that's going to feed back into potentially a lower inflation. Okay? You can model these as rational expectations, if you've heard about that term, but more generally it's the ones on which there is some feedback. Now, over the last 12 months, I think it is reasonable to assume that this share of agents is no longer 100%. You've lost some capital of inattention. How do I know that? Open the Times every other day. Inflation is in the front cover. People are paying attention and trying to figure out what inflation is going to be. I also think that the second group is also no longer zero. Some people have just lost faith in the ECB or the Bank of England. Given that, how do you bring inflation down when you have the second group? You need to leverage the third group. And how do you do that? By acting tough, by which I mean raise interest rates well above the neutral rate. You're raising interest above the neutral rate so that those who respond, they're the ones who are going to cut on their spending, they're the ones who are going to contract the economy towards bringing inflation down. Likewise, though, you want to talk tough. And what is talking tough? Making speeches where you say, all I care about is inflation. Yes, I care about unemployed people, but really, I care about inflation. Why? Not because you don't care about unemployed people, but because you want to regain your captive attention. You want people to say, well, it's 2%, they care a lot about it. When does the central bank dominate expectations? When? Having had expected inflation rise because of a fall in this group, an increase in this group, and maybe an increase in this group, the central bank does not talk or act tough enough to reestablish its credibility and gets dominated through the animal spirits and lack of trust in the central bank. Fears about this, certainly of having central bankers that are afraid of being unpopular, but I think a way to see this, and again going back to some of the things that give me some pause, is really remembering the main lesson of the 1970s or 80s, as I understood it, and as was very nicely modeled by the economist John Taylor. But the point is deeper than really, Taylor rule is just or the Taylor principle is just a particular way of encapsulating it. Throughout the 70s, the Burns regime, central banks were raising interest rates, always thinking that if the neutral rate is here, I want to converge from below. And then they kept on updating above, as I told you, I was converged from below. And what happened? Inflation explodes. Why? Because you always have those backward-looking expectations requiring more and more. And only when you say, I'm going to raise rates very much above even what I think is a neutral rate, the acting tough, which, by the way, you then cut them very quickly. Paul Volcker cut interest rates very quickly right after. But you need that overshooting to converge from above to bring inflation down if you have the expectations of it become an anchor and having a backward-looking effect. And I'm not seeing enough in speeches of central banks saying, I want to overshoot. There's a natural human tendency to think that overshooting is a mistake. And you see speeches recently say, oh, I don't want to overshoot. No. Lesson from monetary theory in the 70s and 80s. You want to overshoot in a situation where expectations are somewhat unanchored. And I think expectations are somewhat unanchored. Overshooting is not a flaw. It is part of the hydraulics of how expectations are high.
Sorry, someone is accessing online. Sorry, we should be muting there.
Okay, no problem.
Sorry.
We have questions afterwards, right?
Yes, we do. Sorry.
No problem. Third, how am I doing on time, though? Because I can't see it.
You still have 10 minutes.
Fantastic, right? Because it reflects there and I can't see it.
10 minutes, yeah.
Okay, third form of dominance. Let's think about fiscal policy here. The payment that you have to how much you repay your debt as a government. You can repay it in three ways. First, through primary balances, surpluses if you want, or lower deficits. Second, through a term that recent research has been emphasizing, very much because of this picture, which is what's been called debt revenue. In other words, the fact that you're able to sell government bonds because of their specialness for a much higher price than the equivalent market return would require. It's basically, this gap is the debt revenue, if you want. And third, by the market value of then future debt. What happens when you have a fall in bond prices is that debt revenue falls. And when that revenue falls, either you're going to have austerity or you're going to have default. How can monetary policy come in? Monetary policy can come in because if you lower policy rates, because there is a relation between the policy rate and the government bond returns, there's going to increase the bond prices and therefore allow you to keep some debt revenue. And second, because you can of course always just buy the bonds, make them more special by making them scarcer, given the demand that there is for them. When does the central bank fiscally dominate? When it does not, again, raise interest rates enough, bring inflation under control, because it fears breaking the government's budget, shrinking debt revenue too quickly. It is the fiscal authority that dominates. And how does this translate over the next 2 years, potentially? Let me show you that revenue in action. In the last 20 years, this is for the G7, with dashes is the US one, we've had a big increase in government bonds, a lot of borrowing. And yet, if you look at interest payments on that debt, they've been extremely stable at around 4%. How? At the same time, we've run very large deficits. How was this possible? It was possible because, again, instead, the gross revenue from debt, the red line, has increased and increased. Right now, and over the last few years, before COVID, we were paying 5 to 6%. We're getting 5% of debt revenues every year by simply the ability of selling government bonds at an overinflated price. Now, it is tempting, therefore, to say, let us make sure that keeps on happening. Let us not raise policy rates too much, because that will crash government bond prices. However, that will work for 1 year or two, maybe only a few months. But you have to go back to why do we have the debt revenue in the first place? It's because government bonds are special. Why is it that government bonds are so special? Let's go back to, again, the theoretical argument. Safety, liquidity, collateral. What does inflation do to all of them? It ruins all of them. I don't think it is a coincidence that government bond became very special in the last 20 years precisely as we controlled inflation in the last 20 years. Because especially for an advanced economy like the UK, where default is highly unlikely, that is the main risk of a government bond, holding a government bond, is that you're going to have inflation eroding your value. If you eliminate inflation risk, bonds look very safe, they look very liquid, they're very good as collateral. If you now let inflation go, you're going to find yourself with a debt revenue that shrinks and shrinks and shrinks, and in the long term, you end up actually worse off. Similarly, you could say, well, okay, I'm going to raise rates, I'm going to try to bring inflation down, but to preserve the debt revenue, to preserve bond prices high, I'm going to buy a lot of them. Why don't I raise rates and expand the balance sheet? No. In a small amount, 3 weeks ago, the interventions of the Bank of England were kind of along those lines. Okay? Motivated by different reasons, by the way, but at least qualitatively along those lines. Issue with that is to realize that, again, the debt revenue is when you're overpaying for the bond. That's why the government's getting a revenue. But the central bank is getting a corresponding loss. And indeed, those losses are going to materialize, as we're seeing already with the central bank making losses, and in making losses requiring either recapitalization for the treasury or a loss of credibility in the currency. Fourth, I need to speed up a little bit. Financial intermediaries. When you raise rates, issue is that lending rates do not go up by one, but often go up by more than one because of an increase in market power of banks. Likewise, when you raise rates, deposit rates don't go up by one, but by less than one because of market power of banks. In other words, intermediation margins widen when you raise rates. That means that there's going to be large redistributions among the financial sector when you raise rates aggressively. As you do so, there will be winners and there will be losers. Now, you can use macroprudential policies. Indeed, the consensus of the last 10 years is that I can use macroprudential policies to insulate monetary policy interest rates from having to worry about these redistributions and these potential financial stresses. But note that in an environment in which I am raising rates to control inflation, what that calls for, if we're putting financial stress, is to loosen macroprudential policies so as to give some respite to the banks that are suffering that. It requires potentially being ready to be more of a lender of last resort in some circumstances or not, so that again the cracks created by the raising rates can be potentially offset in preventing a financial crisis. The dominance comes when, jump to the dominance, first when groups are lobbying for respite from the redistribution cost, and the central bank is hesitating to see rates, and you can see already that happening on a daily basis in the pages of the FT with different groups saying, well, don't raise rates too quickly because I'm going to lose in that. But secondly, also the unwillingness now to use macro-prudent liquidity policies, which always seem to have one direction, instead of the opposite direction in terms of trying to prevent financial dominance of monetary policy. Let me skip that one just because this is a very ECB one. Finally, and I want to finish with this purposely, which is real activity. Raising rates can cause recessions. You may be afraid of causing a recession by raising rates. That is not just understandable, that is good monetary policy. And that's why I want to talk about these dominances, end with this one, because maybe you should be dominated by financial, fiscal, and the other considerations, and you probably should definitely be partly dominated by real activity. Dominance is not really a 0-1. However, as you look at a 3-year horizon, you have to think about whether you are paying too much attention, and that's what I mean by dominated by some of these concerns. And the issue here is that as you look at a 3-year horizon, you may be tempted in the next 6 months to say, I don't want to raise rates too quickly. And that may be the right thing to do, because that would imply a recession that could be quite deep in the last year. But as you look over the next 3 years, you have to realize that in doing so, as inflation persists, we know that Phillips curves flatten. That is, you start getting less and less of a benefit in employment as opposed to inflation by delaying that rate hike. And as you do that, you become dominated. This has been a popular story of what happened in the 1970s, is that you became dominated by always trying to avoid the recession, always trying to keep employment up. And then 3 years go by, and 5 and 10, and you discover that the Phillips curve is very steep, that actually there's very little to gain in terms of recession. That is the dominance. Worrying about recession is right, or in the short run. Being dominated is persistently every year delaying and delaying and delaying, and then you actually don't get any benefit. Here also, a difficult thing is, we are going through a very large terms of trade shock. There's just an enormous increase in the price of energy that we import. The productive capacity of the economy is lower. A recession is inevitable next year. A central bank that refuses to acknowledge this and says, no, I need to keep unemployment at the lowest record level ever, is a central bank that ultimately is overestimating potential output in the economy, and again, as a strong lesson in monetary policy for many decades, is going to let this fear of what is a recession that is inevitable and trying to avoid it lead to high inflation. Let me conclude. Economic policy and monetary policy always requires a balancing act. Some of the dominances that I talked about in the short horizon are just trade-offs that absolutely central banks should consider. You should not raise rates tomorrow by 500 basis points to bring down inflation, because you will break the fiscal budget, you will break the financial sector, and you will break the economy, the real economy, into a recession. You would be a fool to do so. The question, though, is looking forward, those trade-offs become dominance as we look forward in the horizon. And as we look over the next 3-4 years, the horizon try to take, is whether you do not do the required shift between these and let these factors, which are useful balancing acts, become instead forces that dominate. So I summarized here the 1, 2, 4, 5, 6, 7, 8, 9, 10, 12 factors, all of which are, and I'll conclude there by saying this was very much of a talk that gives economists a very bad name. I was asked, I thought, what's going to happen in the next 3 years? And I said, what's the worst that can happen? And so this was 25 minutes of what's the worst that can happen, meaning, under what conditions can it be that we lose control of inflation? And I came up with 12. And my goal with these 12 is so that I can look at them confidently and look at the Bank of England policy and say, no, maybe, but really no. And I get to the end of the list and say no, and inflation will safely be at 2%. But so that also, as an observer, as an institute observing the Bank of England and thinking, discussing monetary policy, we can also look at this and say, yeah, we're failing on number 3 or number 7 or number 10. We should be worried, we should be critical now. And hopefully not. Then we get 3 years from now, in 2025 or 26, we look back, inflation did stay high, and say, it was definitely number 2. And that's what happened as a diagnosis after. Thank you very much.